Hello and welcome. In this video, we will learn more about bonds. Alright? Now, whenever companies or government or municipalities want to raise money, they issue bonds. And the bonds are first issued in an IPO. Okay? Just like stocks are first issued in an IPO, bonds too are issued in an IPO. And banks, mutual fund companies, PF fund houses, high net worth individuals, and retail traders. So, all of these can participate in the IPO. Or, in other words, all these can apply to buy bonds in an IPO. Okay? Now, whenever a bond is issued, the face value is fixed for the bond. Okay, for example, 1000 rupees face value bond, 10,000 rupees face value bond, 1 lakh rupees face value bond, and there are few which have more than this too. Okay, now this is the amount that a person will be loaning to the company. Meaning, if a retail trader like me wants to buy a bond, I can buy 1,000 rupees bond or a 10,000 rupees bond. If I do that, it means that I am lending 10,000 rupees to companies, governments, or municipalities, or I am giving 10,000 rupees as a loan to all these. So this 10,000 rupees will be returned back to me at the end of the tenure. Tenure may be 1 year, 2 years, 5 years, 10 years, 20 years, we do not know. And until the tenure, I will be receiving an interest on the face value. Okay, I'll talk about it later. So just know that anyone can participate in an IPO. Now, there are rating agencies. Which look at the financial health of the company and look at many other factors of a company and rate the bonds. Okay, rate the bonds. These ratings affect many things. Let us see that in detail. So these rating agencies rate the bonds of companies. The ratings are categorized under 4 headings: prime grade, high grade, upper medium grade, and lower medium grade. AAA graded bonds are of highest quality. They are safest bonds, meaning the companies that give out bonds and which are rated AAA are the safest in the market. So if you invest in this bond or these bonds, then your money is safe. How did the bond get AAA rating? That is when the rating agencies looked at the company's financial health. What do you mean by safety? It is safe. It means the companies will pay you your money back. Companies have the capacity to pay your money back. Okay, you are giving them loan, correct? So you have to get back your initial principal amount. How capable is the company? According to that, the rating is given. Next is AA plus, riskier than this. Next riskier is AA minus, A plus, A, and we go down till this. So according to safety, this is in decreasing order. This is the least safest and this is the most safest. Okay. Now, credit ratings are of two types: investment grade and non-investment grade. These are all of investment grade, meaning are of these are worth investing, or the bonds of these grades are of worth investing. Non-investment grade, we don't need to worry about them. Okay. Now, when we say this bond is safest, it also offers the least interest. Why? Because the bond is safest. Because the bond is safest, you will get your money back. Your money is in good hands, and for that reason, the companies offer the least interest. And as we go down, the interest rates goes on increasing. So here, since this is the least safest, the interest rates of these bonds will be highest. Okay. Next, these companies, credit rating agencies, these will be continuously monitoring the companies, and they can upgrade or downgrade the grades. Meaning, let us say a company has AA minus grade, and next year it can be upgraded to AA grade, or it can be downgraded to A plus grade. Okay, and this will be done by the rating agencies. We don't have to worry about it. But if a company gets downgraded, then it is worrisome. Okay, it is worrisome to the investors and also to the company. It is not a good thing if a company gets its bond downgraded. Okay, the interest rate may also vary. Since it becomes more riskier now, they may have to pay more interest. If a company gets upgraded, then it is good. Investors' sentiment gets increased. They are happy now. Okay? So it affects many things. You must know about this. Now, when I say the safest, when I say least safest, what are the risks involved in bonds? There are these many risks. Okay? And we don't have to learn about all these because this is not a series on bonds. If I talk about risks, it will take 2 to 3 videos. Just know about 3 risks: interest rate risk, default risk, or credit downgrade risk. Credit downgrade risk is what I explained now. Okay, the credit of the bond may be upgraded or downgraded, and that risk is inherent in the bond. Default risk and credit risk are almost same. What happens here is the company fails to pay the interest. We pay or we give loan to the company, correct? And the company is supposed to pay us interest. Let us say today is the date when I am expecting an interest. The company fails to deposit my interest or give me interest. If that is the case, then it is default risk or credit risk. What are the reasons? The reasons are many. The company might not be having money. Okay? For whatever purpose the company had taken loan, it did not work out as planned. Company doesn't have money to pay me or pay us. Or the company might not be having money right now. There may be a payment coming to the company in the next week. So it may get that. After that, it may be capable to pay us interest or many other things too. But default risk or credit risk is when companies do not pay us our money. Okay? And we have interest rate risk. To explain this, I'll take an example. Let us say this is me. This is me. Okay? I buy a bond in 2020. Okay? and this bond has a face value of 100 rupees, and the rate of interest that they offer is 5%. Now this 5% is on the face value of the bond. Remember that the face value of the bond may go up or go down. It may go to 110 or it may come down to 95. But the 5% that we get is on the 100 rupees. Alright? Yes. Now I have bought this bond in 2020 and it matures in 2025. It is a 5-year bond. Now, in the next year, let us say the same company or a different company of same credit rating and everything else issues a bond which offers 7% interest. Now, in this case, what should I do? Should I hold on to this bond which offers me 5% till the end, or should I sell this to someone else and buy this bond? Correct? So that is the question. Now, what I would like to do is, I would like to sell this bond and buy this bond. But I have a problem. I am not able to buy a seller. When I approach a seller and say that I would like to sell my bond of face value 100, the seller says, why would I buy this bond from you? I can buy this bond which is offering me 7% interest. So this is the problem. Even though I want to sell, I cannot sell it to the seller because he would buy this because this is more profitable. So what do? I say, see, I had bought it at 100 rupees, but I would like to sell it at 95 rupees. To this, the buyer may agree and he may buy my bond at 95 rupees. And I can go ahead and buy this. Or he may say that 95 is too costly. And in that case, what would I do? I would reduce it further to 90 rupees. So from 100, 90 rupees. So I am saying that I am willing to sell it at 90 rupees. So the buyer may buy it at 90 rupees. Okay. So this is one case. The opposite is true too. I have bought it in 2020, 100 rupees face value, 5% interest it is paying me. Next year, a bond is issued which is paying 4% interest. Now, buyers are ready to buy this. But then I tell to the buyers, see here, this bond is offering you 4% interest. I have a bond which offers 5% interest and I would like to sell this bond to you at 110 rupees. The buyer may be happy and he may buy the bond from me. You see, I had bought the bond in 2020 and its maturity is in 2025. I might be needing money in 2021. Okay, I might be needing money. If I want money, then I can sell the bond. And if the condition is favorable, I can increase this and I can sell it at higher rate. So 110 rupees. So this person can buy it from me. Alright. So this is why I said the face value can go up or down, but the interest payment is on the face value. Meaning, if this person buys this bond at 110 rupees, he will still be getting 5% of 100 rupees. Or if this person buys my bond at 95 rupees, he will still be getting 5% of 100 rupees as interest. Okay. So this is a risk which is inherent in the bond. All right? Yes. Now, companies offer bonds in IPO and they have ratings. And according to this, people look at it and people go for buying it. And once they buy the bonds or once they get the bonds in an IPO, then it is considered as primary market. Or in primary market, people or agencies or companies buy bonds from these entities. And once it is done, they can be traded amongst themselves in the secondary market. Let us say that this mutual fund house has got the bonds in an IPO. Let us say that these people have got bonds in IPO. Now they can trade, meaning they can sell their bonds to others who are willing to buy in the secondary market. Alright, so the trading happens in secondary market. I hope the concept is clear.